What if I told you that you could be paying thousands in taxes every year completely voluntarily? In the next few minutes, what I'm going to do is I'm going to show you how one couple was unknowingly paying $29,000 a year in taxes to the IRS just by where they kept their money. And this big mistake might be costing you thousands too. And the topic here is voluntary taxation. If I look at voluntary taxation and say go on Google, if you look at Google, it talks about the topic of voluntary taxation. And if you look at that, it's a theory of taxes should be voluntary. This is not at all what I'm talking about. Paying your correct amount of taxes to the IRS is absolutely mandatory. You could face criminal or civil penalties by doing that. What I am talking about here is I'm talking about there's two systems of taxation, one for the informed and one for the uninformed. And my goal today is to educate you on how you can legally keep more of your money away from the government. When we look at this, you have to understand that it's not your patriotic duty to pay $1 more of your fair share to the IRS. But if you're doing your own taxes or using a CPA that's simply recording history instead of planning for the future, you could be falling into what I call voluntary taxation. And today I'm going to show you 4 specific areas that can help you in looking at your tax return in areas that maybe you could be bleeding money, and I'm going to show you how to fix it. So the goal here is to simply shift your money. You want to shift your money from the taxable category to the tax deferred category and ultimately get it over into the tax-free category. Let me share an example with you. First of all, I want you to meet Pete. Pete's retired. He's married. Life has been good. Pete was a successful saver and a business owner for quite a few years. And if we look at the numbers on his tax return, the first thing that we're going to do is we're going to go to line 2B. In looking at line 2B, it's going to talk about the amount that he has in taxable interest. So again, because Pete was a good saver over the years, he's built up a lot of money in savings, money market accounts, and CDs. And, if we look at things today, the good news is those fixed rates are some of the highest we've seen in, 15 or 20 years. So he's earning a lot more interest today than what he would have earned 5 years ago. And because of that, on his tax return, it's showing up about $122,000 of taxable interest that's reported on his tax return. He thought he was being smart. Obviously, he's locking in some of these higher interest rates. He's been able to take advantage of where those record rates are. But if we look at the brutal truth of that, assuming in this case, let's say he's earning 4.5% interest on his high interest savings and CD account, he's going to have to subtract 24% of that to pay, in this case, federal taxes. That's going to equal a 3.42% net return after taxes. Now, we also now need to take into consideration inflation, right? If we look at it, inflation has definitely come down, but I would say as a personal consumer myself, inflation is still the real deal. Just go take your family out to eat, go on vacation or things like that, and you'll find out that inflation is still the real deal. If I look at the inflation data as of, July of 2025, the government reports inflation to be at 2.3%. So we're going to take his 3.42% return. We're going to subtract that inflation factor of 2.3, and Pete's real return is now only 1.12%. To me, that's not wealth building. That's wealth erosion in a couple of small steps. At least he's not going anywhere forward. And so what could he have done in a different situation? First of all, Pete has the ability where he could look at tax-free municipal bonds. The second thing that he could do is he could look at high interest tax deferred annuities. The third thing that he could do is he could look at owning, his growth equity accounts and his non-retirement accounts, leave his income producing assets, his more safe money in his retirement accounts, because in a retirement account, that income's not reportable. It's just reportable when he takes his withdrawals. Or he could look at tax-free wealth building using life insurance if, legacy planning was important. So each has their pros and cons, but any of these would have beaten giving the IRS a 24% tip on money you're not even spending. So let's look at case number 2. Case number 2, let's introduce you to Helen. Helen's still working. She's single. She's got good income for work. She's also been a good saver. If we look at her tax return and we look at line 3B, what we're going to see is that she has $27,800 in taxable dividends. That's going to translate on her tax return to about $6,700 in extra federal taxes, even if she's not using the money that she had to pay. Plus, in addition to that, looking at her tax return, she had $3,500 in taxable interest. That's roughly another $850 to Uncle Sam. Here's the fix. The fix in her situation is what I would call asset location. You want to, again, you hold your dividend paying investments inside of your retirement accounts where they can grow tax deferred in traditional IRAs or 401ks and potentially tax free in Roth IRAs. And you want to keep your growth investments in your taxable account. At Helen, in your situation, if you're still working, you could consider maxing out a health savings account. It's the only account that I can think of that has triple tax advantage. So you get tax deduction by going in, you get tax deferred growth along the way, and you get tax free coming out for medical expenses. It's using the tax system in your favor versus letting it work against you. Let's look at case study number 4. On this one, it kind of really makes me angry because in this example, I want you to meet Sarah. Sarah's retired, she's 75, and Sarah loves to donate to her church. She donates $10,500 to her church every year, and it's a beautiful concept, right? She can pick an organization that she cares about and see locally the impact of what her church is doing to help carry on their mission. And she knows that she's being part of that. But, if we look at her tax return, what she's doing, she's taking money out of her retirement account, she's paying taxes on it, then she's donating what's left over. So if Sarah's in the 22% tax bracket and she wants to net $10,500 to give to her church, she has to withdraw nearly $13,500 just to net the amount. Because what's going to happen is when she takes it out from her IRA, she's going to end up paying roughly about $3,000 in taxes. And ultimately, then that $10,500 is going to be the net amount left over that she can donate it over to her church. So that's almost $3,000 that's been wasted in taxes. And here's the smarter way. It's called qualified charitable distributions. And if you're over 70 and a half and you donate to a charity, donate directly from your IRA to the charity. What it's going to do is, number one, it's going to give the charity 100% of the donation. The donation, if you're also at required minimum distribution age, would count towards your RMD amount. And then it's also because you went directly to the charity, 0% of that distribution is going to show up on your tax return. So Sarah could have saved roughly $3,000 in federal taxes. She had the potential that she could have actually helped her church even more. And it's a win-win that the IRS doesn't advertise at all or enough about. In case study number 4, what I want you to do is I want you to meet Rick and Stacy. So what they had done is Rick and Stacy had retired years ago. Stacy had purchased a company of stock along the way, and over the course of her career, her company stock did good. And as part of getting transitioned into retirement time, she wanted to reduce the amount that she had in her company stock and her non-qualified stock option plan. And she sold and had gains of about $61,000 in long-term capital gains. First of all, profits are good, right? Profits are what we're trying to do. So I don't want to lose sight of the fact that you want to have profits in the investment that you had. The problem is in Rick and Stacy's situation, by having those long-term capital gains, she ended up with about $9,200 in taxes that they paid on those gains. So, what could their advisor done or, what could have been done a little bit differently in their situation? Well, what they probably should have done is looked at their entire portfolio. So if they had other investments that they owned just besides the company stock and non-retirement accounts, and they could look at some of those that maybe they were potential losers, they could sell some of those losers to offset that gain. So in early November, smart investors are going to run a realized gain loss report. It's like running the tax fire safety drill. You want to see where you stand tax wise, and then you want to make smart moves before December 31st. You have the ability where you could offset some of your gains with some losses that you have. And if you have more losses than gains, you have the potential where you could deduct up to $3,000 per year against your ordinary income. So just remember that if you sell a stock in a non-retirement account, you got to wait 31 days if you're going to buy that stock back before you have the wash sale rule. And again, every year you want to go through, if you have a non-retirement account, running that unrealized gain loss report. I recommend doing it now if you haven't done it, or definitely do it before end of the year and give yourself a little bit of time. That way you have the ability to make a decision of which of any changes that you want to talk about with your financial professional, and also talk with, again, your tax preparer, your CPA, or somebody like that. So as you've seen today, the IRS doesn't always take all of your money. You oftentimes hand it over voluntarily just by not knowing what your options are. Whether it's interest income, it's dividends, it's IRA distributions, or it's capital gains, the choices you make today determine your tax bill for this year and for years to come. And that's really why Retirement Tax Partners is here at our office. And that's why they create that what if analysis and the tax roadmap. By doing that, it's going to get you three powerful things. It's going to get you a 25-point saver checklist, looking for missed opportunities. You're going to get a personalized roadmap that aligns your investments, your income, and your goals. And then they're going to provide you a tax what if analysis that shows you in black and white, how much you could save by making some strategic shifts within your plan. We've got links in our description below on our YouTube channel. You can sign up on our website at arhq.com, or you can call us at 419-794-3030. Ask for a tax review by our tax professionals at Retirement Tax Partners. We can put that together for you, and we can help you with determining what are the ways to reduce the amount of taxes that you're paying voluntarily.